Welcome to our weekly market review, and it is rates week in South Africa. Now, amid the moderating inflation, the rand which staged a recovery, and the modest growth in the country's money supply metrics, the central bank in all likelihood is going to keep rates on hold. Rather, the discussion has turned to when the SARB will start cutting rates. Now, what will be interesting to watch is the bank's inflation forecast, which could provide some insight into how far off the first cut might be. The ZAR received a further boost on Monday morning. S&P Global has decided to keep the country's credit rating unchanged, which is as good as we can currently hope for. It warns, however, about several risks, and it has added to the pressure on the state to establish economic reforms. Tougher fiscal rule to contain state expenditure, shrinking the size of the government relative to the economy, and implementing far-reaching reforms to rescue SOEs, including allowing the private sector to be part of the solution. Now, this cannot be new news to the state, but perhaps it can stress the urgency with which these reforms are required. One just needs to read the recent reports on the chaos at South Africa's ports to realize that these reforms cannot come soon enough. The rand gained most of its support, however, from a weakening dollar. The greenback has come in for deeper correction as markets are turning increasingly convinced that the Fed has reached its peak in interest rates and will look to cut rates in 2024, which could be as early as May. Now, there are a number of data points to suggest that the monetary policy has been sufficiently restrictive. Most recently was last week's retail sales, which slowed in October. It has been a key economic driver. Last week's CPI data also showed that inflation cooled in October, and there are signs that the labor market is loosening. Unemployment is expected to edge higher in November. Tuesday's minutes on the Fed September policy meeting will provide further insights. Speaking of inflation, last week's CPI release showed that inflation has slowed more than expected in the UK, but the central bank is likely to remain cautious until core inflation is sustainably heading towards its 2% target. Meanwhile, inflation is also moderated over in the EU, confirming that price pressures in the Eurozone are declining at a rapid rate. Now, this supports the case for the ECB to start considering rate hikes, perhaps even as soon as the second quarter of next year. This week's string of PMI data out of the world's major economies will provide a fresh read on the global growth momentum. Now, economic sentiment is expected to remain weak given the tight monetary conditions. China could provide some support, though. The economy has seemingly picked up some steam in October, as per last week's better than expected industrial output and retail sales data. Stimulus measures are clearly filtering through the economy, providing some oomph. And while this is good news, it's still too early to call a recovery, given the prevailing weakness in the property sector. Another thing we will be following this week is the upcoming meeting by OPEC Plus members. Now, the big question is whether member states think it's necessary to further cut output as they face weakening oil prices as well as subdued demand amid an economic slowdown. That then the week that was and the one to come for the markets. For more of our analysis and some interesting conversations, check out our podcast, Reset the Frame.